The American financial system is on the brink of collapse, and we're all sitting in the dark while the countdown ticks away, with record-breaking debt levels, stagnant wages that haven't budged since the 70s, and corporations raking in profits while lobbying to weaken the very regulations meant to protect us. We've built an economic house of cards. This isn't just another bubble waiting to burst. It's a system-wide failure brewing beneath the surface. And when it breaks, it could shatter the illusion of prosperity that's been sold to us for decades. We live in a world full of things to worry about, and it often seems like everything is converging at once. On the surface, we're dealing with what would appear to be a traditional recession caused by the usual culprits: rising interest rates, market volatility, and a slowdown in economic growth. But beneath that surface, there are layers of complexity that make the current situation feel different, almost as though it's the culmination of issues that have been bubbling up for years. As these issues unravel, the combination of declining confidence and peak debt levels creates a perfect storm for economic instability. It's often said that the Federal Reserve tends to raise interest rates until something breaks. The question we face is whether the Fed is simply accelerating the inevitable, or if the system would have found its weak spot regardless. It's like water building up behind a dam. You can't always predict which brick will give way, but you know the pressure is mounting. Financial systems are intricate and interconnected, and as confidence erodes and debt becomes increasingly burdensome, the pressure builds. Eventually, something breaks, and it's usually something no one saw coming. Take the collapse of Bear Stearns in 2007, for example. The investment bank's failure took many by surprise despite clear warning signs on their balance sheets. The same could be said for the more recent collapse of Silicon Valley Bank in 2023, which seemed to catch the world off guard until analysts took a closer look at its financial health. These instances highlight a broader truth. The first domino to fall in a crisis is often unexpected, and the ripple effects are impossible to predict. However, history teaches us that after every major financial bubble, a recession follows. The severity of that recession depends on how well the system's leaders respond. Looking back over the last century, we can see a pattern. In cases like the 2000 dot-com bubble, the subsequent recession was mild. In other cases, such as the Great Depression following the 1929 stock market crash, the economic fallout was devastating. It's clear that poor decision-making, especially when it comes to regulation, can have catastrophic consequences. The housing bubble of 2008 is a prime example of this. Subprime mortgages were allowed to proliferate unchecked, despite warnings from people like Brooksley Born, who advocated for greater regulation of financial derivatives. Yet her efforts were stifled by figures like Larry Summers and other policymakers, who believed that the financial system could regulate itself. That mistaken belief brought the global economy to its knees. We're at a similar crossroads today. Since the housing crisis, there's been an ongoing debate about whether regulations have improved enough to prevent another catastrophe. Meanwhile, corporate lobbying continues to erode these regulations, particularly in sectors like tech and finance. Silicon Valley, for instance, successfully lobbied to roll back regulations that had been put in place to safeguard the economy. The assumption was, once again, that capitalism could self-regulate. However, as history repeatedly shows us, it can't. Without oversight, the system tends to prioritize short-term profits over long-term stability, leading to the very crises that regulators seek to avoid. It's important to recognize that what we're experiencing now isn't just a typical bull or bear market cycle. We're dealing with something much rarer and more dangerous: a bubble. These bubbles are easy to spot in hindsight, but they often go unnoticed in real time because of the widespread euphoria that surrounds them. In the case of the 2000 dot-com bubble, the stock market soared to 35 times earnings, yet many failed to recognize the warning signs. Similarly, the U.S. housing market in 2006 experienced a 3 sigma event, a once-in-a-century phenomenon driven by artificially low interest rates and speculative buying. It took aggressive policies to push the market into what can only be described as a state of irrational exuberance. Once these bubbles burst, the damage is profound. Historically, the real pain in the stock market doesn't occur until after the first interest rate cut. That's when the decline accelerates, as it did following the 2000 bubble when the Nasdaq dropped 82%, and the S&P 500 fell by 50%. This was despite a relatively mild recession. The fallout from the 2008 housing crisis was even worse, as GDP contracted and corporate profits disappeared. In the most extreme case, the 1929 crash, the economic impact led to the Great Depression, one of the darkest periods in modern economic history. What we're heading into now is an unknowable bad time. The depth of the economic downturn will depend on how effectively governments and financial institutions respond, but one thing is clear: we're entering this period with historically high profit margins and a system that seems ill-equipped to handle the challenges ahead. One of the most concerning trends we're seeing is a shift in the way capitalism operates. For the first time in decades, we're witnessing a system where corporate profits are rising faster than wages. In previous periods of inflation, like the 1970s, profit margins would decline, and real wages would rise. Today, it's the opposite. Corporations are increasingly using their market power to raise prices while holding back wages, creating a system that benefits shareholders at the expense of workers. A big part of this problem is the growing concentration of corporate power. Over the last 20 years, we've seen a steady rise in monopolies and oligopolies across various industries. In the past, companies would reinvest their profits into building new factories and expanding their operations, which created jobs and fueled economic growth. Today, however, shareholders are pressuring companies to cut back on capital expenditures in favor of stock buybacks. This strategy artificially inflates stock prices by reducing the number of shares available, but it doesn't contribute to long-term growth. This shift away from investment and toward stock buybacks has had profound consequences. For one, it has created a system of artificial scarcity. By withholding investment, companies create a mild shortage of goods and services, which keeps prices and profits high. This is great for shareholders, but terrible for workers, who face stagnant wages and fewer job opportunities. It's also bad for the economy as a whole because it slows down productivity growth and limits innovation. Let's talk about stock buybacks for a moment. They were illegal for much of the 20th century because they were seen as a form of stock manipulation. The rationale was simple. Corporate insiders have more information than the average investor, so allowing them to buy back their own shares gave them an unfair advantage. That logic still holds true today, yet buybacks have become a central feature of modern capitalism. When a company buys back its stock, it's essentially giving a dividend to its least enthusiastic shareholders, the ones who are ready to sell. This pushes up the stock price, benefiting insiders and long-term shareholders at the expense of the broader economy. Warren Buffett has defended stock buybacks, arguing that they can be a good thing if done in moderation. But when buybacks become the primary way that companies return value to shareholders, it signals a deeper problem. It means that companies are no longer investing in their future growth. Instead of building new factories or hiring more workers, they're simply buying back their own stock to prop up prices. This short-term thinking is one of the reasons why U.S. productivity growth has slowed in recent decades. This brings us to the issue of wage stagnation. Despite significant gains in productivity since the 1970s, the average American worker's real wages have barely budged. Adjusted for inflation, wages are stuck at levels not seen since the 1980s, while corporate profits have soared. This growing disconnect between workers and shareholders is one of the defining features of modern capitalism, and it's a major factor behind rising inequality. Interestingly, other countries haven't experienced the same level of wage stagnation. In places like France and Japan, real wages have risen significantly over the last few decades. Even the UK, which has faced its own economic challenges, has seen wages grow faster than in the US. The difference comes down to corporate governance. In the US, the rise of shareholder capitalism has led to a system where profits are prioritized over wages, while in other countries, workers have been able to secure a larger share of the economic pie. The final piece of this puzzle is inflation. We often hear about wage inflation as a threat to the economy, but what we're really seeing is greed inflation. Corporations have taken advantage of the disruptions caused by the COVID-19 pandemic and the war in Ukraine to raise prices far beyond what is justified by their costs. This has allowed them to maintain, and in many cases increase, their profit margins while workers bear the brunt of higher living costs. Capitalism, as it currently operates, has become a highly efficient system for maximizing profits, but it's not designed to address long-term societal needs. Climate change is a prime example. For decades, oil companies actively worked to sow doubt about the science behind climate change, delaying necessary action to reduce carbon emissions. This has likely cost us precious time in the fight against global warming, and we may now be facing a future of increasingly severe climate impacts. In conclusion, the current state of capitalism has led us to a point where short-term profits are prioritized over long-term stability. The system has become so focused on maximizing returns for shareholders that it has lost sight of its broader purpose: to create sustainable growth and improve the well-being of society as a whole. Whether we're talking about stock buybacks, wage stagnation, or the rise of monopolies, it's clear that the system is in need of reform. The question is, will we take the necessary steps to fix it before it's too late?